Hi, it's the Money Guy, Adam Phillips, and this week is the second episode of my banking series, and we're talking about savings accounts today. Now, predominantly there are two types of accounts you can get: cash-based savings accounts and non-cash-based savings accounts, which sounds a bit more complicated than what it is. Basically, you get normal savings accounts you can get at the bank, instant access, ISAs, some cash-based ISAs. You can get fixed rate monthly savers, all sorts of different things. Anyway, the ones you open up at the bank with an advisor there is usually a cash-based savings account. What that means is if you put £100 into a pot, you'll get an amount of money back, a return relevant to the size of the money that you put in. In other words, if you've got £100 and you put it in a savings account and the interest rate is 2%, you'll get £2 back, assuming the £100 is in there for the full 12 months. So you make money on the money that's already in the account. Therefore, it's a cash-based savings account. Then you can get non-cash savings accounts. So think things like stocks and shares, or perhaps you might go and buy a vintage car, do it up and sell it on in the hope to make more money than you originally put into it. So it's an investment. Investment doesn't necessarily also risk to your capital. Your capital is the amount that you put in. It's a fancy word. They use a lot of these jargon words in the bank, but basically if you put in £100, that's your capital. So if you put £100 into your investment, that's your capital. There are some investments that you can get that guarantees your capital. So regardless of what happens in 3 years or 5 years, however long you want to tie it up for, you're guaranteed to get all of your money back, plus usually a small amount of money as well. Like anything in life, the greater the risk, the greater the reward. So you can get some really high risk investments. Those are the ones that could lose your money, but potentially those could also earn you the most money as well, certainly way above inflation. The best advice I can give you is to go and talk to one of the advisors at the bank before ever going ahead with any of these sort of things. They'll know the product inside and out, and they are qualified and insured to give you the advice that you do need. Cash-based savings accounts, there are a load of different variations for this. You can get instant access savings accounts, which you put money in, you take money out, as its name suggests, it's instant access. You can get fixed rate monthly savers. These ones is when you agree to put in a certain amount of money every single month, usually by standing order. You can get 1 year bonds, 2 year bonds. Again, these are just where you lock the money away and you can't get at it for 1 year or 2 years. If you can get at the money, there's usually quite a hefty penalty involved as well, so it's usually not worth the hassle in taking it out. So only put money into them if you know you definitely don't need it for the 1 year or 2 years. The thing with cash-based savings accounts versus investment accounts is that people often put into them because they see them as a safe bet, which the capital is. However, if you put £100 in an account today, what would you be able to buy with that £100 in 10 years' time? And that's the thing you have to remember. There is always a risk associated to any kind of savings account, whether it's a high-risk investment or whether it's a no-risk or low-risk cash-based savings account. The cash-based savings account, if it's only giving you 0.1% and the rate of inflation is, say, 2%, then you're 1.9% down from where you need to be. Again, I put it in English for you. If it's £100 you've put into the pot and inflation is at 2%, that means next year you need £102 in order to buy the same things that you could have bought with £100 the year before. If your interest is only giving you 0.1, so you've got £100, you've been given 0.1%, so you've got your 10p, brilliant. You'll need another £1.90 to pay for the same things that you could have bought the year before. Therefore, the capital is safe, the £100 you're going to get back regardless of what happens, but the value of that £100 is not. So you have to make sure that whatever you're doing, this is why you need to review your savings on a regular basis, because there's a lot of savings accounts that will give you a bonus perhaps, or give you a great deal for the first year or even maybe the first couple of years, but then suddenly the interest rate ducks right down. If you're not sure what kind of deal you're on, or if you want me to help look at it, or you want to talk about any of your cash-based savings accounts, feel free to give us a call on 07951 314 857, or of course message me on my Facebook page. Just look up It's the Money Guy, or go to the website www.itsthemoneyguy.com.